Good morning, traders. It's 8 a.m. Chicago time, 9 a.m. Eastern. Thanks for joining me again for another Trader Bite. It is Wednesday, the 3rd of May, 2017. Um, Middle of the week here. Very sluggish trading this week. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. This morning, it looks like we're on a risk-off stance coming into the open today. The markets that are positive. Crude oil took a big drop yesterday, I think, from the stock market open. It dropped, which is a half hour after the crude pit open. It dropped about 2.5% this morning. It's up 10 cents or 0.21%, trading at 47.76. The laggard today is the Russell 2000. The Russell's off 6.2 points or 0.44%, followed by gold. Gold's trading at $1,253.10, down almost $4 or 0.31%. All of the indices are off to some degree. The S&P 500 down 3.5 points or so, down 0.16% again, risk off coming into today's session. As far as news and what's potentially driving the markets, we just got ADP. The ADP release just about 45 minutes ago. ADP is a private payroll processing company here in the U.S. It's very large, and they do their own, based on the payroll that they process for private companies. They do their own employment change report. The ADP came in at 177,000 plus 177,000 versus 175,000 estimated. This is the lowest ADP release since October. Prior revised slightly lower from 263 to 255. So you can see the drop is quite large. Remember, this preempts the non-farm payroll release this weekend. Other than that, overnight we got a bunch of numbers. The German April unemployment change came in at negative 15,000 versus negative 11,000 estimated, so slightly worse. Unemployment rate still at 5.8%, which is where it was expected. The change for the prior month for March was revised down to negative 30,000 from negative 29,000. The UK released April construction PMI. Came in at 53.1 versus 52.0 expected. This is the 8th month of expansion in the UK construction PMI. Eurozone Q1 advanced GDP came in. This is quarter on quarter, came in at 0.5 in line, year on year 1.7 in line as well. And then also the EU released some draft negotiating mandates for the Brexit talks. As far as what we're expecting going forward today, today we're looking for some key figures. We've got U.S. Services PMI final coming out at 9:45. That's just 15 minutes after the open for April. Expecting 52.5. ISM non-manufacturing at 10 o'clock. That's a half hour after the open. 10 Eastern. All times are Eastern. ISM non-manufacturing for April 55.8 expected. Then we get the crude oil inventories. Negative 3.5 million, so a 3.5 million draw for last week on crude oils. U.S. distillate inventories looking for a surplus of 1 million. Gasoline inventories looking for a surplus of 1 million. Crude took the API release yesterday, which came out after the close, was slightly bullish for crude. We saw crude shoot up right around the 3:30 Central, 4:30 Eastern mark. So we're expecting this inventory report to also show something along those lines. There it is. API, the weekly API inventories came in at 4:30 yesterday at negative 4.2 million draw on crude oil. The prior was a surplus of 900,000 barrels. This was the largest draw since January of 2017. If you're trading energies, this is of interest. At 2 o'clock today, we get the FOMC rate decision, expecting 0.75% on the lower bound, 1% on the upper bound, no change from prior months. And then after that, this morning, the FOMC holds a closed-door meeting in Washington, D.C., starting at 9, which has started 5 minutes ago. Not sure if any press releases or anything are going to come out of that. That's what's on deck for today. So we have the FOMC, which probably is plays a big part in the just god-awful trade yesterday. And then after the market today, we get Tesla and Facebook. Okay, so let's switch gears and look at what we expected yesterday. Here's the expectation for yesterday. Yesterday, based on where we have been and the fact that we were opening against the MC point of control. This is the MC microcomposite. It's a profile that incorporates everything that's highlighted by this dotted box. We were opening right up against it, and the expectation was for a drop, and then there was plenty of energy here to push us higher, in my opinion. And I was looking for a strong shift up after dilly-dallying and chopping around and chopping people up in the morning. I was looking for it to release upwards as the primary possibility. The second possibility, which is basically what occurred, was for it to stay in range. So we stay in range, and for it to have a drop at some point, and then to finish somewhere in the middle. What happened yesterday, though, is the drop occurred early, then it pushed up, then it pushed down again, and then it finished in the middle. Yesterday, something you want to... Hang on one second. Yesterday, something you want to note that's very important, at least from the auction perspective, is that the first hour's high and low, which is the initial balance, that's these yellow lines here. These yellow lines are the first hour's high and low. The initial balance is important in that it measures the most active, the period in the day where the higher time frame or the bigger players are most active, which is the first hour. Okay, so we look for the first, used to be 4 pit brackets when the market's biggest participants get their business done. Those who are operating on a day time frame or a larger time frame generally get the business done. They make a decision to buy or sell, and then the market opens, and then on the open, those positions are put on by their brokers or themselves, and then that establishes the initial balance. And we use the initial balance to measure what the rest of the session is doing versus the opening auction, and that's why it's important. Now, the statistic that we have to keep in mind here is that the probability that the initial balance, high or low, is not broken. In other words, the session opens, a normal session without holidays, without anything, opens and closes without the initial balance, high or low, breaking. In other words, the market trades inside of this, is somewhere around 3% historically over 2,500 days reviewed. Okay, so a sample of 2,500 days, we look at days where the initial balance is not broken. In other words, the market trades inside of the first hour's high and low. That occurs 3% of the time. Yesterday was one of those days. The market just was never able to break out. We saw it break to the upside in the NASDAQ. We definitely saw it break in other products. But in the S&P, it just seems like we were on holiday, and the market just traded sideways on pretty low volume. Look at the volume yesterday for the S&P, 834,000. That is approximately 300,000 contracts. Yes, 300,000 contracts, lower than what we would consider to be the common the common amount traded during the pit session. Remember, this is a pit session only, day session only chart, and so something here tells me that all hands are off on the equity indices, especially this one. The Nasdaq has been strong, has been leading. The Nasdaq has made new all-time highs, while the S&P just sits in the middle here and isn't getting anywhere just yet. And so yesterday marks this really important fact that we end up with a double distribution profile, a completely clear double distribution profile. The the low volume node, or the cutoff point in the distribution, the key low volume node, is right on top of the MC point of control. Really bizarre stuff here, kind of stacking up. It just seems like the S&P is setting up for a potentially large move, very large move out of here. It is resting, it's consolidating. There's very little interest. It's compressing. We stayed inside these dark green lines right here. This green line and this green line, that is the prior day's high and low. So we stayed inside of the prior day's range, Monday's range, and then we stayed inside of the IB. It is really, really consolidating. Yesterday I was expecting this to break and have enough energy to push through at least to 23.95, and it just did not do so. So we'll see if that happens today with the FOMC. I expect that the movement today to be more of a hedging style trade. We are looking weak on the open. To push forward and see where the volume has been added, I'm going to walk this profile forward. Keep your eye on where the volume gets added in here. And so as I push forward, all we're doing is we're adding to this MC, and we're making it much, much sharper. Look at how sharp this MC is. Again, there's a lot of volume being built in here. In fact, we can see what that is by adding volume to the bottom of this. We can see 6.04 million on the day session traded inside of this this MC so far. There's plenty of energy here to carry us, although that seems pretty light for a profile that's been going for a week, given that we've pushed to the high. We've had a couple of volatile days last week. It's still very, very light. So this is what things are looking at like yesterday. Now, coming into the overnight session, we see that we traded sideways through the until the Asian Open. The Asian Open brought us selling, and we have not been able to recover. And we have put in an LVN right on top of the point of control from yesterday, and so we have this low volume node right at 2384.50 or so. 2384 even, is it? So, yeah, 2384 even. And the market has just basically sat sideways. We are beneath the mid of the session. We're tangled up into the VWAP of the session, and we are pressing up against a very poor low. Look at that low. If I zoom a little bit, you can see how the volume just drops off dramatically on the low. Pretty weak low. I expect the overnight low to be taken out quite early this morning. So that's what we're looking at. Like, this to me looks like 4th of July trading or something. It really is pretty bad. As you know, if you find yourself just wondering if you'll ever make money trading, this isn't a good time to make that determination. It really is a tough trade. And I'm not making excuses here. It's just the way the market is. It's not always going to be as active as we'd like it to be. The more volatile the markets are, the more I'm able to extract from the market, but also the more likely it is that you will take bigger losses. And I'm okay with taking bigger losses on higher volatility because I can also have the gains because I have the discipline to hold on when things go well. Here's your VIX. I'm just showing it here. Let's see if we can bring in a few more days. Let's go back a little bit. Here's your VIX. So the VIX climbed very quickly, um, and has had this huge drop, this historic, like 26 or 27% drop over that weekend with the Brexit, and has pushed to 9.9 on the low side on the VIX. It's pretty damn awful. It's this. I have not seen. I don't think I've seen these levels since about late 2005. Or sometime in 2006. It really is a grind, which tells you as a trader that it's really important to be very very picky about when you commit your money into the markets. Okay, this is the time to test your patience. As I said last week, I believe one of the hardest things to learn as a trader is not when to take a trade, it is when to not, when to be patient, when you're supposed to sit versus take action. That is a hard thing, and that's why your plan needs to be pretty well defined. It doesn't have to be complicated. You should be able to fit your entire plan on a little post-it pad, really, but it's about sitting out. That's the hard part. So what have we accomplished so far? Really, not much. I mean, the market keeps pushing. When I look at the profile, it keeps pushing one bracket to the next. It just keeps pushing. Um, so you can see here the bracket, the first bracket, the second bracket breaks 2 ticks below the first bracket. The third bracket breaks 2 ticks above the second bracket. The fourth bracket breaks 2 ticks below the um, third bracket, and then and then a consolidation in the fifth bracket, and then we finally get a break, and we just keep taking these. I is 2 ticks below H, and so on and so forth. It's really really choppy when you look at the price action alone, which is what I use the MP, the market profile for. So this is what we've got. Now, what do we have going forward? I've run out of time. As much as I would want to sit here and talk about how awful this is, I mean, look at the range here. I keep the scale is set. My scale on a 15 minutes set to 60 points. Okay, so it runs from about 23.55 to 24.15, and look at how tight that look at how tight this is. It's really really tough. And so just be patient. This feels like summer trading right now, and that's what we have in front of us. As far as what we're expecting today, we're opening down just below yesterday's range, potentially an open auction out of range. I expect that it'll push in a little bit and become an open auction in range, but I'm looking for a drop, a pretty healthy looking drop. I'm looking for it to test the 2-day low, get down below 23.78 quarter, and potentially push to that 23 again. 75 is the mid of the gap. I'm looking for that to be tested today. So I'm looking for 23.75 to be tested down here. I'm looking for a higher low, and I'm looking for the market to push back up to 23.85, the MC point of control, and then to finish somewhere in the middle. And then we get FOMC. Now, I don't know what will happen after FOMC. Volatility is expected to come in, but then overall, depending on what the stance of the Fed is, and I am seeing signs that that the curve is flattening out just a tad on the short end. Um, it's potential. There's a potential that the FOMC, especially meeting this morning at 9 a.m. and so on, the FOMC is likely to go into a holding pattern, which market might find bullish. And if it does, then I'm looking for 23.95 to be taken out, and then look for it to push through 2400. If the Fed holds on to the position that it wants to raise rates, then look for it to break through the gap get down to 23.70, 75, and bounce back up and finish somewhere around 23.82. We've been trading around the 23.80 to 23.85 handle for the last 3-4 days, and that's the equilibrium point. That is hypo 1. Complicated because of the FOMC, but that's what we're looking at for hypo 1. Okay, if we get responsive buying, which I do not expect, then I'm looking for a push into yesterday's range high around 23.88, and then I'm looking for it to go into a holding pattern. The FOMC comes in, very boring trade this morning. Then the FOMC comes in, and then you basically have the same targets, 95 to 2400, and then 75.75 down to 70.75. I can't be more precise than that or more descriptive than that because the FOMC comes in a little bit later on. Just be careful today. Keep the powder dry. Hold on. Be patient. Be patient. It is really compressed. When the market's compressed, people lose interest. They get bored. They start to swing for the fences and taking bad trades. Understand that compression or balance leads to imbalance, and that creates an opportunity. You want to be sure to have the emotional capital and the psychology and the discipline to be able to take advantage of that. When we consolidate, as we've been for the last week or so, generally we're likely to break pretty hard out of the area. We'll see that coming again and again and again. FOMC is at 2 p.m. Eastern, 1 p.m. Central. That's 7 p.m. GMT. Good luck today, and I hope you're gaining something out of these Trader Bites every morning. I wish you the best. Take care.